Hi guys, a very good morning to all of you and a warm welcome to the today's session. If you have reached this particular lecture, then I believe, I hope, I wish that you have already seen the lecture number 1. Because whenever a student starts a subject afresh, and that too with a fresh teacher, new teacher, there are a lot of questions popping up in the mind. How this journey is going to be, what is the methodology that sir will adopt to teach us, and a lot more things. So majority of these questions I have already answered in detail, in depth, in the lecture number 1. So if by chance any of you have missed that lecture intentionally or unintentionally, I request you to please close this window and go to lecture number 1 first, see that, and then come back to this lecture. I welcome once again to this journey of financial management fast track, one of the wonderful subjects in our syllabus. And you should all take a kind of pledge with me that yes sir, we will score maximum marks in this subject, because if I am going to teach you, I am going to pour in my all of experience, all of the teaching experience and the study experience, and believe me child, there will be no stone left unturned by me in this teaching, in this particular fast track batch, and you will all be able to score maximum marks in the coming attempt. You just have to keep following me. Whatever I will say, whatever I will teach, whatever I will write, you should just do the same thing. And whenever I give the homework, I expect you to do that homework, so that we are doing the practice side by side. And it is usually said, whenever you are starting something afresh, then you should take the blessings of the elders and the God. So we pray to the Jagannath Puri and the Tirupati Balaji and all the other gods that please bless us in this journey, that the God should bless me while teaching and all of you to study, so that you can all do well in the coming examinations. So with this, we start and we embark on this, I should say, adventurous journey of the financial management. If any of you has studied this subject earlier from any other teacher, believe me, I'll change the perspective this subject is studied. So guys, let's not wait more, let's not talk more, and straight away come to the business. Straight away come to the business. Okay, so everybody, I believe you are all having a fresh register. Some of the backbencher student, I can do it in the cost register, I can do it in the advanced account register. No! If we are serious about the exam, if we are serious about the attempt, then it should be shown in our actions as well. So please arrange a new register, fresh register, take out the first page and write down the name of the subject as financial management. So first of all, we are going to understand, because usually students also sometimes think that why this particular subject is being studied, what is the meaning of this, what is the importance of this subject, why it has been introduced in our syllabus. So those all questions shall be answered first, and after that, after a little some time, we shall start with formally chapter number 1. So this subject, financial management, popularly called in the short form or nickname as FM, financial management. This subject is of such paramount importance that wherever you are studying in India or even in abroad, in any graduation, be it any geographical area, it may be Punjab, it may be Tamil Nadu, it may be Kerala, it may be Gujarat, it may be Maharashtra, Rajasthan, wherever you are studying, in the graduation, you always encounter this subject. The name of the subject may be different. Sometimes it's called financial management, sometimes it's called management accounting, sometimes it's called management accounting and finance. More or less, the content of this particular subject remains the same. So what does it talk about? What does it talk about? First of all, let us understand that. So we know there is something called balance sheet. We all know when we entered in the world of commerce, we got to know that yes, there is something called balance sheet as well. There is something called balance sheet as well. So if I try to make a balance sheet in T shape, just for the purpose of understanding, it has liabilities on one side and the assets on the other side. If I place the liabilities, so liabilities are equity share capital, preference share capital, First of all comes the share capital, then reserves and surplus, then comes the long term debt, then comes the long term debt, which you may say is debentures, or it may be bond, or it may be loan, etc. And finally there is the short term. Finally there is the short term. I should preferably write it as, I will preferably write it as a bigger head, current liabilities. Current liabilities. On the other hand is the fixed assets. On the other hand is the fixed assets, then investments, and then current assets. So we are making a rough kind of balance sheet just for the purpose of understanding the meaning of this subject. Don't take it on your heart that sir, we have seen somewhere sir the balance sheet format looks quite different. Don't worry about that. This is not account, this is financial management. Okay, so when a person starts a business, what is the first and foremost thing that comes to mind? The funds which he has to invest in the business. Now how the funds can be arranged, and we are talking about a company form of organization in our this subject. Whenever we are talking about any particular topic, we are talking about the corporate form of organization, company form of organization. So first of all, the main challenge to start the business is to arrange the funds. Now there can be some funds which are with you, but for the other funds you are dependent upon the others, and you can raise that amount either in the form of equity share or preference share, and over the time you will build your retained earnings, that is reserve and surplus, plus you can take the amount of loan in the form of debenture or bond or loan or borrowings, etc. from the banks. Now this is the first part. If I consolidate in one head, this is called as child, this is called as finance. This is called as finance, that my business is financed from this, and this is known as financing decision. So first of all, when we start our subject, first of all we shall deal with the financing decision, in which the different chapters come. So financing decision comprise of total 4 different parts. Financing decision comprise of total 4 different parts. Financing decision means the decision to be taken with respect to finance, that how my business will be financed. Now once you have arranged the sources, the next step which comes is that now you have to invest this amount. Where you will invest it? For example, I am having a factory. I have set up a factory to produce the phone. So in that factory I will install various machines, and there will be a lot of workers. Then there will be the office space where I will arrange a lot of furniture, computers, laptops, etc. Administrative assets, you can say. Means I am investing the amount which I have collected in the fixed assets, plus it may be possible that for the timing my amount has not been invested somewhere, so my amount has not been invested in my business, so I will keep that amount as an investment in some avenue so that I may get the return. So the next step after raising the money which comes is the investing. So that is called as investment decision, or you can say investing decision. So there is one chapter with the name of capital budgeting, that is called as the investment decision. So that belongs to this particular criteria. Finally, if you see in the balance sheet, there are 2 things left. One is the current liability and the other is the current asset. If I join, okay, not in this manner, if I join these two, current asset and current liability, if I see their net impact, current asset and current liability, the consolidated study of current asset and current liability is categorized under the head working capital management, and under this working capital management there are total of 3 chapters. One is estimation of working capital, one is debtors management, and the third one is cash management. So you can see the study of the balance sheet is nothing but the financial management. If you see the name of the subject, financial management means you have to manage what? Finance, management of finance, and finance means money. And where is the money being shown in the organization? Balance sheet, the amount which you have raised, the amount which you have invested, and the amount which you have raised on short term, and the amount which is tied up with others in the short term current asset. So consolidated study of balance sheet is nothing but comprised under the subject financial management. So I hope you are having a clarity now why this subject and how this subject is being done. Okay, now we will formally write down first of all our syllabus, and then we'll start with the chapter 1. Come on, child. So we are marking our syllabus. We are marking our syllabus. Write down number 1, cost of capital. We will write the chapters in the hierarchy we will have to do in the class. First of all, capital, then leverage, child, then capital structure. Please keep noting it down. Number 4, theories of capital structure. Number 4, theories of capital structure. Number 5, capital budgeting, or this chapter is also known as investment decision. Then comes next estimation of working capital. Then comes chapter 6, estimation of working capital. Then comes debtors management as number 7, child. Number 8 being cash management. And there are 2 chapters which are not directly seen in the balance sheet: ratio analysis and the dividend decisions. Ratio analysis and the dividend decision. So these all chapters are in our syllabus except the theory one. So I am not writing down the theory chapters over here. The first 4 are categorized under the head, as I told you, in the financing decisions. Then capital budgeting, it is also called as I said, investment decision, that where my funds are to be invested on a long term basis. And then these 3, estimation of working capital, debtors, and cash management, come under the major head of working capital management. Come under the head of working capital management. Child, please note till here, then we move ahead. Haji guys, I hope we have noted this down. So this is our complete syllabus which we have to do. We start with the chapter number 1, that is our cost of capital. So what we will do, we will first do financing decision. We will first cover this, in which we shall follow the same hierarchy: cost of capital, leverage, capital structure, and theories of capital structure. The cost of capital is the largest of all. It is going to take the maximum time out of the financing decision. Then capital budgeting. A lot of students must have heard and have this preconception in mind that yes, it is very difficult chapter. It is not at all difficult. We will do it, no problem. Then comes the 3 heads of working capital. Finally, it will be ratio analysis and the dividend decisions. Okay, so please take out a fresh page and write down the name of the chapter: cost of capital. Cost of capital. Okay, before writing anything, let us understand what does it say. So cost of capital, what do you understand by this? If we read it as a first glance, it simply says cost which is being incurred for using the capital. Now what is the meaning of capital? Capital means the amount which is being put in the business. When we entered in the life of the commerce, then capital was the first thing usually taught, that when a person wants to start the business, they have to invest some money, that is called as the capital. Okay, now we are talking about the company form of organization, in which students generally think that capital means only the equity and the preference capital, but no, capital simply means the amount which is being invested on a long term basis, which covers equity capital, preference capital, reserve and surplus, and even the amount of long term debt, that is debenture or loan or bonds, etc. Now, when the company, for example, I am the company and you guys, all of you who are watching my lecture, are my investors. So when I am asking the amount from you, you are giving the amount to me, and in return I am giving you certain shares or debentures, right? So I am using the capital which is not mine, it belongs to all of you. Then for using your money, I will have to pay some cost to you, I will have to incur some cost, that is called as the cost of capital. So each and every company in the universe who is using the money of the others, they have to pay them the amount for using their amount. For example, it's very simple to understand. For example, you become a chartered accountant and you say, now I want to buy a car. It was my long seen dream ago that I have to buy a car. So you want to buy a car having a value of rupee 20 lakh and you are having rupee 8 lakh. You want to arrange rupee 12 lakh more. So how will you arrange that? You will go to the bank. You will say to the bank, please give me loan. If the bank approves your loan, you have taken rupee 12 lakh from the bank and you have to repay this 12 lakh in the form of EMIs. Every month, a portion of this you will have to pay. But if you total down all the amount of all the installment, will it become rupee 12 lakh? No, it will become more than 12 lakh. It will become more than 12 lakh because you are using the money which belonged to the bank and you will have to incur the cost. You will have to return that money, that's for sure. You have to return that 12 lakh. But other than 12 lakh as well, you have to incur some cost because you are using the banker's money. In the same way, when the company is using the amount of the various people, of the various investors, you have to incur certain costs, that is called as the cost of capital. So in this chapter, we have to study about this only. Okay, now as it is the first lecture, there will be some things which will be new for you, which will be, it is the first formal lecture in which we are starting with the subject, in which we are starting with the chapter. So that's why you may encounter certain new things, but gradually by the next lecture, you will feel comfortable because every teacher has its own style to teach. And my style is such which is suited to each and every student in all India. So you don't have to worry about that. We work in a very formal professional manner, in such a manner that when you revise these notes at the time of your exam, there will be a big smile on your face that yes, sir has taught me good, sir has written down each and everything very clearly. And you have to also write this down because, child, please listen to me very carefully. When this batch will be over, you don't have to watch the lectures again. Your notes, the notes which you make during the classes is your best companion, so you have to write down each and everything in a legible manner which could be understood by you when revising. Okay, so let's write down concept 1 basics. When I'm going to teach, I told you in the previous lecture that I will write down each and everything concept wise. I divide the full chapter into various concepts and then I teach as per the concepts. So concept 1 basic, I will assign a number as well to each and every concept. So concept 1 basics. Now under this concept, we will write down something and I will teach you something and then we will shift to concept 2 and accordingly so on. Write down. So first of all, let's write down the meaning of capital. Capital means all the long-term sources of finance, and cost means expense. So we are saying capital means all the long-term sources of finance. So if you see in the balance sheet, all these are the long-term sources of finance and this one was the short-term source of finance. So we are saying about the long-term. So long-term source of finance, each and every source is included: equity, preference, reserve and surplus, and the long-term debt. Okay. Cost means expense. Now, cost of capital means consolidating these two, combining these two. Cost of capital means the cost to be incurred, for various sources of finance. So if I combine these words, cost of capital means the cost to be incurred. Why? For various sources of finance. Means when the company is going to use the source of finance from the people, then they have to incur the cost, that is called as the cost of capital. So we are saying on this end is the investor and on this end is the company. So investor is moving the funds to the company. Investor is giving the funds to the company. In return, the company will give something to the investor. Now that is called as the cost of capital. The amount which the company is going to pay, for company it is a cost, but for investor it is a return. For company it's a cost because they have to pay that, they are incurring that, but for investor that's a sort of return. For example, if you have taken some equity shares of a company, if the company is paying you the dividend, so it's a cost for the company, but as you had invested the amount, when the company is paying the dividend, it becomes a return for you. It's as simple as that to understand. Okay, so this is the thing. Now we said cost of capital means the cost to be incurred. Will the cost remain same for all the sources of finance? As we said, cost capital means all the source of finance and cost means the expense. So does the cost remain same for all the source of finances? No. For equity capital it will be different, for preference it will be different, for reserve and surplus it will be different, and for debenture etc it will be different. So let's write down. Cost varies as per the risk attached to a particular source. Cost varies as per the risk attached to a particular source. So out of all the sources, we have to see which one is more risky from the investor point of view, because usually we come across the term higher the risk, higher the return. So when the investor is investing in a particular security and he knows that he is taking a risk, so accordingly he will expect a higher return, because if the investor logic is very simple, he says, boss, if I want a less return, I will simply invest my amount in a lesser risky security. I can go to any post office or bank, I can keep my money in the fixed deposit, I will get a fixed return 6, 7 or 8% depending on the market scenario. But if I am taking the risk and I am investing in a company, means if I have come to till the share market, to the point of share market, means I want a good return. And out of that also, in share market thousands of companies are there. If you are investing in a company which appears to be risky, why you are investing that amount? Because you are expecting then higher return from that particular organization. Okay. And you also have to understand this whole subject we have to study from the viewpoint of the company. That's why we have written down the chapter's name as cost of capital, because for company it's a cost. Otherwise we could have written return on, the chapter's name could have been return on amount invested. But no, the return word is useful for investor, and I said we are not studying from the point of view of investor, we are studying from the viewpoint of the company. Because once you qualify, when you are in practice, you are going to give your services to the organization with respect to this financial management. If you are not in practice, you have joined a particular organization, over there you have to work for that particular company, not for any particular person. So the chapter is studied from the viewpoint of company. There will be one or two specific situation when we have to think from the investor viewpoint. I will specifically tell you at the time. Otherwise, the chapter will be studied from the company point of view. So let's deep dive a little into this thing, cost of capital. So we are going to make a particular diagram. In that diagram, we shall see. Okay. So I am writing over here the meaning of capital. It can be share capital, it can be reserves and surplus, or it can be debt. Further, the share capital can be equity share capital or preference share capital. And if I talk about the debt, it can be in the form of debenture or loan or bond. So this is capital. Next comes the cost. So what is the cost which is incurred by the organization for the sources? For example, first of all, you have the equity share capital. The company's cost on equity share capital is the amount of dividend which it pays. Similarly, on preference share capital, the company pays the dividend. But are they same? No. The dividend which is paid is variable on equity capital, whereas the amount of dividend which is paid on preference share capital is fixed. If I talk about the debt, irrespective of whether it is debenture or loan or bond, the cost is known by the name of interest. Sir, you left reserve and surplus. I am coming to that. Sir, why have you written that? Sir, because reserve and surplus do not have any cost. So, first of all, this is a misconception in your mind. Reserves and surplus definitely have the cost. Reserves and surplus definitely have the cost. How? I'm going to explain, don't worry. If I see the nature of the cost, nature of the cost, whether explicit or implicit, what is the meaning of this? So it used to be, it was taught in the economics, the types of cost behavior, explicit and implicit. Explicit cost means where the actual outflow of money takes place and you have to pay the amount to the others when the actual outflow of money takes place. So if I talk about the share capital, does the company have to pay the amount of dividend? Definitely they have to pay. So share capital cost is the explicit cost. Does the company have to pay the amount of interest to the others? Definitely yes. So it is again the explicit cost. For in the case of share capital, the company has to pay the amount of dividend to the shareholder. In the case of debenture, the company has to pay the interest to the debenture holder. In the case if you have taken a loan from the bank, the company has to pay the interest to the bank. So these are all explicit costs. But when you talk about the reserves and surplus, generally people think reserve and surplus do not have any cost because this is my amount. For example, if I have to start a business and it requires rupee 5 lakh, I am having 2 lakh of my own, so I need to arrange only rupee 3 lakh from other sources. If I invest my 2 lakh, means I have invested my reserve and surplus. Question arises, is there any cost? The usual answer is no, it doesn't have any cost because you don't have to pay the cost to anybody else because it was my amount only. But if you look from the finance professional eyes, then you will understand the viewpoint. If there are two ways to understand. First way, if I would not have invested this rupee 2 lakh in my business and I could have invested this 2 lakh somewhere else, I could have earned certain return which I have not been able to return. Means there is a cost involved, there is an opportunity cost. I could have earned the return. For example, there is a 7% return on the FD. If I would have invested 2 lakh in the bank's FD, yearly I would have earned 14,000 rupee which I have not been able to earn. Fair enough, we understand that. The second way to understand, if I would not have invested my 2 lakh but arranged this 2 lakh from some other sources, in that case I would have paid. So investing my amount, I just have saved the amount which I could pay to the other in the form of explicit cost, but this amount definitely has the cost. The only point is this, I don't have to pay it to anybody else. So this cost is known as implicit cost, that it's just that you don't have to pay it to anybody else, but definitely the cost is involved. Very, very important, please note it down. Haji, I hope it's been noted. We will quickly do a comparative study of the debt, preference capital, and equity capital so as to gain more insight. So, write down the heading comparative study of debt, preference capital, and equity share capital. Write down debt, preference share capital, and equity share capital, and we are going to judge on various points. So, first of all, what is the return for investor? What is the return for investor? In the case of debt, the return is interest. In case of preference capital, the return is dividend. And in case of equity, again, the return is the amount of dividend. Is return short means we want to say क्या पक्का मिलेगा, means if you have invested this amount as a debt holder or preference holder or equity holder, is it sure that at the end of year you will get the amount? In case of debt, yes, it's sure because interest is an item of charge against the profit. It does not matter whether the company has earned the profits or losses, the interest has to be paid. Whereas in case of preference and equity, it is not at all sure because dividend is paid only when the company earns the profit, otherwise not. Next is return fixed. Is return fixed means if amount is paid to you, is it already prefixed that you will get this amount? In case of debt, yes, the interest rate fixed. In case of preference also the dividend rate is fixed, but in the case of equity it is variable. Totally it is variable. Next comes risk. So what is the risk? What is the degree of risk? In case of debt, for example, if you have invested in a company as a debt holder, so are you taking a less risk or high risk? If I compare all these three, debt, preference and equity, if you are a debt holder, your risk is least. Why? Because return is short and you already know what you are going to earn. Whereas in case of equity, return is not short and even it is not fixed whether I will get it or not. So the risk is highest. Risk is, I will say maximum risk is maximum in case of equity capital. In case of preference, the risk is moderate because only this thing is not sure where because return is not sure, but once it is sure that the profits have been earned, then my return is fixed. So it is having a moderate risk and the return typically depends upon the return for the investor, typically depends upon the risk. We are using the word return for investor and we are using the word cost for the company. We are using the word cost for the company. So in case of debt, the company knows that the person who has invested has taken the least risk. So company's cost is also the least. And in case of equity, the cost is maximum because equity holder are the owners of the company. So once the company is earning the profits, the shareholders are very happy because their market price per share is going like shoo in the share market, just going up. And in the case of preference, the return for the investor, that is the cost for the company, remains moderate. Please note it down as well. Haji, I hope till this point we are very clear. I am going very slow, not increasing the pace, should be understandable to everyone, and this is the quality of our notes which I am talking about. We are going to write each and everything. I will be using a different color pen because that's my habit when I was a student as well, and now when I'm in the teaching profession as well. It's my habit that I will keep writing each and everything in this manner only, and this is not only till the first day. Students usually think first day hai na, chod maar raha hai. It is his first day, that's why showing his tactics. We will see till the last chapter, Rahul, how you behave. So Rahul is here only. You will see the same quality till the last lecture, till the last chapter. You don't worry about that, boss. I know my quality. So you should ideally make the notes in a similar manner so that you don't face any trouble at the examination time. I am saying again and again, students usually think, okay, this is the first time I am seeing the lecture. After completing the syllabus for revision, I will again watch the lectures. If you think so, then you will not be prepared for the coming attempt, because your whole time will be, you hold for the full time you will be busy in just watching the lectures. But no, you have to watch the lectures only once. After that, you have to read it, study it from the notes, and keep doing practice, practice, and practice. Okay, let's moving ahead. So one more line from my side for cost of capital. Please write down cost of capital represents the cost of capital represents the minimum required rate of return represents the minimum required rate of return to be earned so as to at least meet the cost of various sources of finance. So we say that cost of capital means this is the cost you have to pay. So it's as simple to understand that if this is the minimum cost to pay, you have to pay this. So means first of all you will have to earn that. If you are not even able to earn that, then there is no logic in running the business. In that case, please shut it down, because you have raised the money from the people and you have to pay them the return. You have to incur the cost and you have to pay them their return. So this is the minimum which you have to earn. If you are not able to earn this, then there is no logic. So we say it represents the minimum required rate of return to be earned so that you can meet the cost of various sources of finance. So now formally writing down the last thing in this concept one, that in this chapter how many costs we have to compute, and how we have to progress. So in cost of capital, the first thing is we will find the cost of debt. We will see how to find cost of debt. The next one will be cost of preference share capital. Then it will be cost of equity share capital, and then cost of reserves and surplus. So in this manner, we shall go ahead and we shall find out the cost of each and every source of finance. And once we have found out all of these, then we will be prepared to find out the overall cost of capital, because we have to find one consolidated figure from the organization point of view. First of all, we shall find out each and every figure separately. It is represented like this. Cost of debt is represented as KD, cost of preference is represented as KP, cost of equity is represented as KE, cost of reserve and surplus KRE, means retained earning, and overall cost of capital is represented as KO. So this is the boundary of our chapter. These all things we have to cover one by one. First debt, then preference, then equity, then reserve and surplus, and finally the overall cost of capital. Okay, so this was all the basic of this chapter. Now we have got a glimpse what is to be done, and we are ready to start with our concept number 2, that is cost of debt. So whenever I am starting a new concept, I will always take a fresh sheet. How you want to do, that's your choice. Obviously, if you can do like this, then it's best. Concept 2, cost of debt. Now when you talk about debt, na beta, there are more than one type of debt. So the most popular being whether the debt is redeemable or irredeemable. Depending upon both the cases, the cost shall be different. So first of all, we are writing irredeemable. We are talking about irredeemable. Concept number 2, cost of debt irredeemable. What does that mean? First of all, let's understand, then we keep writing. Then we'll write irredeemable debt. For example, I am the company, you guys are the investors. So you guys gave me the money and I gave you the debenture certificate. And I said that this is irredeemable debt. It means during the lifetime of the company, you are not going to get the principal amount back. You will just get the amount of interest every year. That's it. You say, sir, I gave you rupee 100 rupee. You say to me, sir, I gave you rupee 100 rupee. When you are going to return that? If the debt is irredeemable, the answer is never. It will be done only at the time of winding up of the company that you will get your money back. Other than that, every year you will just get the interest. So that is called as the irredeemable debt. So we are saying that this is today, this is year 1, year 2, year 3, and nth year, the end year. Now this nth year is not defined. Not defined means it is not stated that how much is the life of this debenture. Zero means present. If in Hindi it's aaj. What is on this date? What is happening at present? That we are issuing the debenture. So debentures issued. Debenture issued means inflow of money. You have got the money. You have got the money, and every year you will pay the amount of interest. I am representing interest as I. So in this case, the only cost is the interest. The only cost is in the nature of interest. The only cost is in the nature of interest. Now keep listening. What we have to do, we have to take the net cost and not the gross cost. Very important. We have to take the net cost of interest, not the gross cost of interest. What does that mean? What does that mean? Okay, I'll show you by the example. So let's take an example to find the net cost of interest. What is the meaning of net cost of interest? So for this purpose, what we do, we make a trading and P&L account. We make a small P&L account, I should say. So there are two P&L accounts. P&L account A, P&L account B. So let's assume there is a GP of 1000. There are expenses of rupee 200, and let's say the tax rate is 40%. So 1000 minus 200, what's the profit? 800. If I do 40% of 800, the amount of tax comes out to 320, and the rest is your net profit, which becomes 480. On the other hand, we write down the similar things by GP. So GP is 1000. There are expenses of rupee 200. This time we say there is an expense of interest as well, rupee 100. So if I want to find out the tax, it will be 1000 minus 300, that is 700. So 700 into 40% becomes 280, and you get your net profit as 420. Okay, so looking at this example now, I did put on debit side an interest of rupee 100. So when there is an extra expenditure of 100 rupee in the P&L, it simply means my profit should decrease by 100. But when you give a quick look to the amount of profit, the profit has decreased by 60 only, whereas you did put a new expenditure of interest of rupee 100. So the profit should have decreased by 100. Why not? Why only 60? Should have decreased by 100. Why it is not decreasing by 100? Then it is decreasing by 60, because when you see the other expenditure which was in the P&L, first instance in A P&L, it was 320 rupee, but it has remained as 280. So if you look at this figure, your tax amount has decreased by rupee 40, and tax was an expense. So there has been a savings in tax. I can say there is savings in tax of 40 rupee, because any expenditure you put in the P&L account, that always results in the tax saving. This is the reason we say that we don't have to take the gross cost. Gross was only 100, this was gross. You don't have to take that, you have to take the net cost of interest. What is the net cost? By putting rupee 100 as expense, you have saved rupee 40, so your net cost is 60 rupee only, so you should consider 60. Now see how does it come. So net cost is simply, net cost is your gross cost minus saving on that. So how does it come? If you see, 100 rupee was the interest amount and 40 rupee is the amount of tax. I'm just showing you how the formula is made. If you don't want to remember it, that's no problem. So 100 minus this 40 is nothing but 100 rupee of interest into the tax rate, that is 40%. So you can write it down as 100 minus 100 into 0.40, and if you take 100 common, it remains 1 minus 0.4, and if I write it in English, it 100 rupees the interest and 0.4 is your tax rate. So your net cost of interest is, it looks like this, interest into 1 minus tax rate. Please note it down and then I move ahead. Okay, ji. Okay, so doing this logic, now we are ready to see the formula which we have to apply in the question. So the formula for KD is I into 1 minus T divide by NP into 100. I into 1 minus T divided by NP into 100. Sir, what is the meaning of NP and all and all? Wait for that. I am here only. I am going to explain each and everything. First of all, we don't have to memorize any formula as such. You should know the logic behind each and every formula. So I am giving you a generic thing to remember. Whenever we are to make the formula for the cost of any particular source, for the cost of capital, the formula is very simple. Cost you are incurring is in the numerator and the funds which you receive from that is in the denominator. Now, when I'm using the funds of irredeemable debt, what is the cost I'm incurring? Net cost of interest. So that is I into 1 minus t. I into 1 minus t. And in divide, what is the amount of funds I have received? What are the inflows? So I have written it down. Debenture issued inflow, and this inflow is known as net proceeds. So that is the full form of NP. It's not net profit. Some students say, oh, net profit. No. Okay, let's write down. So I is interest, and write it like this: interest per debenture. We have to make every calculation considering it a single debenture, because when you are multiplying by rupee 100, it simply means that the answer will come in percentage. Whether you take 100 debenture, 1000 debenture, 1 lakh debenture, 1 million, 1 crore, 1 billion debenture, does not matter, the answer remains same. So we will always do the calculation on the base of one debenture. Okay. How the interest is computed? The formula for this is face value per debenture, child, multiply by interest percentage. This interest is also known by the name of coupon rate. Questions sometimes will write coupon rate. That is nothing but the interest percentage itself. What is the face value of per debenture? Question will give you, it may be 10, 20, 50, 100,000, whatever it may be. But if the question doesn't give, I am telling you straight away, if face value not given, then you have to assume as follows: for debenture, assume as 100 rupee, and for bond, assume as 1000 rupee. For bond, assume as 1000 rupee. Now, some of you may think, sir, you have not taught bond here when I have written the debt. Please remember that debt includes all the three things: debenture, loan, as well as the bond. So debenture and bond are the marketable securities which are actually issued by the company to the people. So for debenture and bond, there is definitely a face value, and if the question doesn't state, you have to assume this value. Okay. And if it is the case of loan, in case of loan, the formula is, because there is no net proceeds etc., for loan the formula is simple: I into 1 minus t. Whatever is the interest rate, okay, I'll put this again into a different bracket. If it's a case of loan, it is this only. So where I means interest percentage itself. So if question is saying you have taken a loan from the bank at the rate of 12%, so write in I 12. If you have taken a loan at the rate of 10%, write 10 instead of I. So that's the only thing, because loan is not issued like debenture and bond etc., so it does not have any face value. Okay, so debenture and bond face value if not given, assume as 100 and 1000 rupee. So first variable was I, second variable is T, and the third is NP. Now what is the meaning of T? A little ago I told you that we are doing this subject and this chapter from the viewpoint of the company. Who is finding the cost? Company. So T means tax rate of the company. T means corporate tax rate in percentage. And the last being, what is the meaning of NP? NP means net proceeds per debenture in rupee. Net proceeds per debenture. I am saying we have to do every calculation on a considering a single debenture. So NP means net proceeds per debenture. How will it be found out? Okay, let's write down. We are making a statement that's very important. First of all, write down face value per debenture. If you are issuing on premium, means you will be able to command a higher price. If there is a premium, add that. If there is a discount on issue, reduce that. If there is a discount on issue, reduce by that amount, and you get something called issue price per debenture. Issue price means you are issuing at this. Remember, we don't want issue price, we want the net proceeds. Now whenever you are making a public issue of any security, you incur certain cost which is known as the cost of issue or flotation cost. Like you may have to pay certain fees of the SEBI. When you advertise about the IPO or FPO in the newspaper, you will have to incur the advertisement charges etc. So considering all those, if there is any such cost, that is to be deducted. So minus cost of issue or it is also called as flotation cost. When you reduce that, you get the amount of net proceeds per debenture, and this is your final figure. Very, very important. Very, very important. So this is the figure of net proceeds per debenture, child. This is the figure of net proceeds. Okay, so we have to work in this manner. Now, whenever, because it's the chapter number 1 which we have started today, so some things are new, like we are writing down everything concept wise, concept 1, concept 2. Now, whenever we are doing any concept, and if it is having questions related to this concept, we will keep solving concept by concept. So now, as we have done cost of irredeemable debt, we will go to our we will go to our blessing book, take out the chapter cost of capital, and we'll find out which are the questions relating to this topic, and will then solve. After this is done, I will give you the answers to be done in the homework from this concept, and then I will start with the next concept, that is concept number 3. And I have already done all this exercise. You don't worry. We are not going to waste any time in the class to find out which are the questions belonging to this topic. I have already done that before coming to the class. Okay, coming to your blessing book of financial management, FM blessing, and take out the chapter cost of capital in that. So you see question number 1, and you see this Guru Mantra. So Guru Mantra are the questions which are to be done in the class, and Abhyasika questions are the ones which you have to do in the homework, which I will tell you which ones are to be done. So if you see against question number 1, there are certain things written. For example, it is written concept number. So which concept number is this? Please write down number 2. Then it is written register number. What is the meaning of this? Obviously, you have started the financial management with me today formally. So this is your register number 1. In this register, you have to number the pages. How? For example, if this is the register, page number 1, on the back of it 2, then 3, then 4, then 5, on the back of it 6, and so on, starting from page number 1 till the last page. If you don't have the time, some you may think, you are a chartered accountancy student, how you can devote such important time from your busy schedule to this activity. So there may be some younger brother, younger sister, or your parents, mother, father, or some kid in the neighbor, or some friend, etc. You may assign them the task. They will feel good to be a part of your CA journey. That please write down the page number. And for example, this question number 1, you are solving on page number 6 in your register. So write down page number 6 over here. Sir, what is the meaning of this? Why are we doing this? Because now sometimes the question is usually asked, and sometimes the question usually crops up in the mind. What do the rank holders do separately? How they are getting a rank? We are not able to even clear the group in the single attempt. How they are getting the rank, giving both groups together and still getting such high marks? So each and every small step counts. These are the things which I used to do when I was a student. The things will look very easy when you're doing with me today, but at the end of the day, there will be many registers which will be filled, homework registers, classwork registers, and at the day of examination, when you have to do certain number of questions and you have to find which question has been solved where. For example, this cost of capital chapter takes almost 70 pages of your register, and you have to find where this question number 1 has been solved. How will you find that? So if I am having already written that it is done on my page number this, and it is in this register, your no time will be wasted finding that particular question. So this is the thing which is going to really matter. And if you have in your life encountered such teacher who is teaching such things, please do that. Please do that. And after that, you see, so there is written answer dash. So some questions may have the straight answer. For example, we do this question, whatever is the answer, you may note it down over here. How will it help? When at the time of revision, you are quickly solving the question and seeing, judging whether you have understood the chapter and whether you are doing it correct or not. So answer you have found on calculator. If the answer matches with the answer you have written here, means yes, it's okay. You can move it to next question. Means you need not even open your register to check. Okay. And after that, you see there is a symbol. There is a symbol like this. So it's a star rating. There are certain important questions against which I will ask you to write whether it is 5-star or not. For all the questions on which we will mark 5-star, you have to definitely solve those at the time of every revision and even during your exam days, because those will be the most important ones. And if if any question you find that this is important point and you should note it down, or for example there are some questions which look very for example, if I take you to this question number 24, now it's a huge question giving a lot of data and asking a lot of things, and it may be possible that on the exam day you are very occupied with the rest of the syllabus. You know that yes, this question is important, but you don't have the time to open the register and see it full. So what you can concentrate on, you see there is written TRG keynote. So in some questions, if there is any important point, you can write down the important point over here only, so that when you are just turning the pages of your book, you see this note and you get to know, oh yes, this was the point. So I need not see the full question, I need to just read this particular point. So these all features have been given by me in the book, because I believe these really can make a difference in your marks. Okay, chaliye ji, come on. So we go back over here, and let's start. So it says the question number 1, dedicated to Rahul Garg. TRG, TRG means मैं, the Rahul Garg, a name given by students. Okay, it says TRG Limited issued 10%, so it's a coupon rate, 50,000 debentures of rupee 100 each. Rupee 100 each means face value of a debenture is rupee 100. Question says, boss, find KD if tax rate is 35%. Okay, how do we get to know that it belongs to concept number 2? Because there is a debt, and how do I identify that it's a redeemable debt or irredeemable debt? If it is redeemable, the question will give the life, that debenture is of 5-year, 8-year, 10-year, 15-year, 20-year, etc. If question is not mentioning the life of debt, it means it is irredeemable debt. So it is irredeemable debt. Okay, let's write down answer number 1. Let's write down answer number 1. So before we apply the formula and solve the answer, first of all we shall fix the values of all the variables. If you remember, there were 3 variables in the formula, I, T and NP. What was I? I was interest per debenture. I told you have to multiply the face value which is given in the question as rupee 100 by the interest percentage, which is 10%, so it becomes 10 rupee. After that I need T. Question says the tax rate is 35%, and when we put in the formula we will write it as 0.35. Then comes the NP. Question has not given any premium, any discount, any flotation cost, so face value becomes the net proceed itself. If you see in this formula, face value in my question is 100. There is no premium, no discount, so issue price is same. There is no flotation cost, so net proceed is rupee 100 itself. After writing down values of all the variables, write down the formula, I into 1 minus T divide by NP into 100 and put the values in this formula. So I is 10, 1 minus 0.35 divide by NP, which is 100, multiply by 100, 6.50 divide by 100 into 100, the answer comes as 6.50%. Now I know you guys are very intelligent. Some students will straight away write down value like this, will not write down this. Believe me child, in examination you don't get the marks only for the answer, you get the marks for the steps also which have been done. So if this question is asked in the examination and you think by writing only this you will get the marks, you are wrong. Ideally we should write down each and everything which belongs to this question in this manner I have done. Okay, so we'll move ahead after this question. This was the question number 1 in easy one. 6.5% is our answer. Okay, let's come to question number 2. So this question again belongs to concept number 2. TRG Limited issued 10%, 50,000 debenture of 100 each at 10% discount. Find KD if the tax rate is 35%. So rest everything remains same. The only thing is that there is a 10% discount. There is a 10% discount. Okay, let's write down answer number 2. Let's write down answer number 2. So I is the face value is 100 multiply by interest rate. So interest amount becomes 10 rupee. Now the usual mistake is made by students while computing I. They say due to discount 100 minus 10% 90 rupee. No, the interest is taken on the face value. The face value is 100 only. Then if I talk about the tax rate, it is 35%, that is 0.35. And if I see the net proceeds, so the question says boss face value per debenture is 100 rupee and there is a discount on issue. There is a discount on issue which is 10%. So 100, that is face value, into 10%, it becomes 10 rupee, and my net proceeds comes as 90 rupee. Our net proceeds is 90 rupee. After that you apply the formula. KD is equal to child I into 1 minus T divide by NP into 100. Now we fill in the data. So I is your 10, tax rate is 0.35, and the net proceeds are rupee 90. 6.5 divided by 90 into 100. Okay, purposely I will write down this step as well. 6.5 divide by 90 into 100. 6.5 divided by 90 into 100, child, you get it as 7.22%. 7.22% is the answer for question number 2. I hope this is again very comfortable. No problems being encountered in this. No problems encountered in this. We move to question number 3. Again, concept number 2. The question says TRG Limited issued 10%, 50,000 debenture, rupee 100 each, 10% premium this time. Find KD if the tax rate is 35%. So the change is, instead of discount, there is a premium. Okay, let us see. So answer number 3. Answer number 3. First of all, finding I, which remains the same, 100 into 10%. It gives me 10 rupee. Tax rate is 35%, that is 0.35. And if I want to find the NP, for that face value per debenture is 100 rupee, and this time there is a premium on issue. This time there is a premium on issue, Puttar. How much? 100 into 10%. The face value, premium or discount, is always found on the face value. So 10 rupee. When you add it up, you get 110 rupee as your net proceeds. And applying the formula, KD is equal to I into 1 minus T divide by child NP into 100. I is 10, T is 0.35, and divide by NP, which is now 110, multiply by 100. 6.50 divide by 110 into 100, you get 5.91% as your answer. 5.91. Okay, so why did we do these 3 questions? Because we have to learn something. If you go back to the book and see, in all the 3 questions, the interest rate was same, 10%, 10%, 10%. The face value was same, 100 rupee, 100 rupee, 100 rupee. The tax rate was same, 35%, 35%, 35%. The only thing which was different, in first case, the debentures were issued at par. Debentures were issued at par. In second case, there was a 10% discount, and in third case, there was premium. That was the only difference. Rest everything was same. So if I see, the answer to first question was 6.5%. Pretty easy. If you see, I said in the numerator will be the net cost, in denominator will be the funds. The net cost, that is 6.5, is same in each of the three questions. The net cost is the same of the interest, but still the KD in first case is 6.5. KD in case 2 increases from 6.5 to 7.22, and in third case it comes down to 5.91. So why such difference? The difference is due to the net proceeds. In the first case, you received rupee 100 and you paid 6.5. In case 2, you received only 90 but still paid 6.5, means you have received the less funds but you have to incur the same cost. That's why we say that due to discount my cost increases, and you can see it rose from 6.5 to 7.22. Whereas in case number 3, you still have to pay only 6.5 but you have received 110 rupee. That's why your cost has come down to 5.91%. So it is usually said that yes, if your security is being issued at premium, means you are in profit. So that profit I can see over here. My KD, if when I issued at par, was 6.5%, but as soon as there was a premium involved, it came down from 6.5 to 5.91. So that was the learning from these questions. Very good questions. Coming to question number 4. Again from concept number 2, let us see. Shikha Limited issued Shikha, my wife. Yeah. So it's my book. I can write down any name. Shikha, my wife. Shikha Limited issued 10%, 5 million debenture. Now the question wants to confuse you by writing 5 million. Irrelevant. I said we have to do the computation on per debenture basis. Shikha Limited issued 10%. So that's a coupon rate. Debenture is of rupee 100 each at 10% discount. The new information, flotation cost is rupee 3 per debenture. Question says find KD if there are no taxes. So in this case there are no taxes but there is a flotation cost. Okay, let us solve this question. So answer number 4. We need 3 things, I, T and NP. First of all, if I say I, 100 is the face value, 10% is the coupon rate, so 10 rupee becomes interest. Tax is nil. And if I talk about NP, question has given me face value per debenture as 100 rupee. It said there is a discount on issue 10%. So 100 into 10% becomes 10 rupee. You get the issue price per debenture as 90. Issue price per debenture as 90. After this, question says there is a flotation cost. There is a flotation cost per debenture of 3 rupee. So finally you get 87 rupee as the net proceed. So this is the way to compute the net proceed. Now the question has given the flotation cost clearly 3 rupee. It may be possible that the question is giving you the flotation cost in totality. By chance, if it gives it in totality, I can find on per debenture basis. For example, question says my flotation cost is 15 million rupee and it said to me there are 5 million debenture. So 5 million ones are and 3s are. So 3 rupee will be the cost per debenture. So if given in totality, I can say if flotation cost given in totality, compute on per debenture basis. Compute on per debenture. How? The formula will be total flotation cost divided by number of debenture. So in this manner I can get it on per debenture basis. So we can write this note. Okay, anyhow, so now we apply the formula. In many questions I have written the formula, so I will write down the straight away values. So KD is equal to I, which is 10 into 1 minus T, the T is 0, divide by net proceeds, that is 87, multiply by 100. So 10 divided by 87 into 100, it becomes 11.49%. 11.49% is the answer. Okay, so this was your question number 4. This was your question number 4. Okay, let's move ahead. So we come to question number 5, again from concept number 2. It says RSA Limited issued 10%, 10,000 debenture of rupee 100 each at 10% premium. Flotation cost is 10%. In previous question it was given in rupee, and in this case it is given in percentage. It says, boss, find KD if tax rate is 40%. Comfortable? Let us see how to go ahead. So answer number 5. So answer number 5, we have to fix first of all the 3 variables. So I is equal to 100 into 10%. 100 is the face value, 10 is the coupon rate. Then tax rate is 40%, that is 0.40. And to find the NP, we will say face value per debenture is 100 rupee. Question says there is a premium on issue. Question says there is a premium on issue. 100 rupee into 10%, there is a 10% premium, 10 rupee. So adding this, you get issue price per debenture of 110 rupee. Now I have to reduce the flotation cost per debenture. This point is one of the most important points in the full chapter. Flotation cost is given to you in percentage. Now the students get confused. We have to apply this percentage on which figure? Some say we have to apply the percentage on face value, whereas the other point of view is we have to apply the percentage on the issue price. The correct one is we have to apply the percentage. Question say 10% is the flotation cost on the issue price, not on the face value. Only if the question itself says that flotation cost is a percentage on face value, only then apply on the face value. Otherwise apply the percentage always and always on the issue price, because flotation cost, if in percentage in real terms in practical life also, is done on issue price. So it becomes 11 rupee and you get your net proceeds as 99 rupee. Okay, now solving it, KD is equal to I into 1 minus T, that is 0.4, divide by NP, that is 99 into 100. So 6 divide by 99 into 100, it becomes 6.06%. So this is your answer. This is your answer. Please note it down. Please note it down. Okay. So there is one very important point which I am telling you regarding the NP. So one very important point. Sometimes question gives market price. If question gives market price, then how you have to compute the net proceeds? Listen to me first before I write this down. Which a cost of capital is always computed for the future. Cost of capital is always futuristic in nature. When we are doing net proceeds, you can see we are saying this is the face value, means we are assuming, we are considering the data that the security, the debentures are being issued today. So this is the face value, this is the premium. But for example, I had issued the debentures 3 years ago. Today, I want to find out their cost. I issued the debentures 3 years ago. Today, I want to find out the cost of debt. So I will not have the face value and premium because these are of no use. These were relevant 3 years ago. In today's date, that is irrelevant. Okay, let's assume I issued at 110 and the issue price was 110. But in today's date, means 3 years down the line, now at the share market, this debenture is trading at 125 rupee. So what do you think? If you have to issue it today again, at what price you will issue? Will you issue at 110 or 125? Obviously at 125. When we know as a company my security is being traded in the share market at 125, why will I want to issue it at less price? So my issue price will be rupee 125. You understood? So if the question gives market price, means first of all it is talking about an old issue. It is talking about the old issue of debenture. How will we find out the net proceeds? We will say market price per debenture and minus any flotation cost from that, and this will give us the net proceeds per debenture. Very, very important. So this is the market price, out of which you will deduct the flotation cost and you will get the net proceeds. So the point is this basically, that when you are issuing, when you are making a new issue, you have the figure issue price because you are issuing it today. But if we are talking about an old issue of debenture which was earlier issued, in today's date, the corresponding term which is relevant to that is the market price per debenture. Okay. So this is very, very important. Very, very important. Okay. Flotation cost ke liye we will write down a note. Flotation cost is computed as a percentage of issue price. Now we know that issue price is relevant in case of old issue, or I will write down market price. Means if the question is talking about an old issue, then we have to do the percentage of the market price. Okay. And flotation cost is to be computed as a percentage of face value only if question says so. Means you don't have to apply it as a percentage of face value on your own. If the question is specifically saying that please charge the flotation cost as a percentage of face value, only then do that. Only then you have to do that. Okay, so this was your concept number 2, and there is, wait. Okay, and there is one question which I am giving you in the homework. So it is like a prasad being given in the temple, accept it with both the hands. An homework question. So there is a question number 36. It is from concept number 2. This will be your homework. This will be your homework for the day. That's all. I meet you in the next class where we take the chapter forward. We will do the study of redeemable debt and so on. Lot of other concepts. Till then, bye bye.